third section. Third section is qualifying transactions and scoping. Qualifying transactions and scoping. Qualifying transactions and scoping criteria. What is that? Third section, qualifying transactions as well as scoping criteria. So in the third section, the report discusses what are the transactions that would be qualifying transactions for this approach. And in qualifying transaction, there are two categories of transactions. There are two categories of transaction. The first category is buy sell marketing and distribution transactions. Buy sell marketing and distribution transactions, wherein the distributor buys from another associated entity for wholesale selling, for wholesale distribution to unrelated parties, right? Buy sell marketing and distribution activities. And the second category is sales agency and commissioner transactions. Sales agency and commissioner transactions. Sales agency and commissioner transactions, wherein a sales agent or a commissioner can assist another associated entity for the distribution, for the distribution to unrelated parties. Right? So these are the two categories of transactions which are in scope: buy sell marketing and distribution transactions, as well as sales agency and commissioner transactions. Now, once you have this, then you move over to the scoping criteria. Scoping criteria. Actually, I intend to make a separate video on this section 3 and section 5. So I'll briefly give you what exactly is contained in scoping criteria. See, scoping criteria, it makes use of the general principles from the OECD TPG chapter number 1. It says that the qualifying transactions, those qualifying transactions will be in scope whose economically relevant characteristics denote that they can be reliably priced using a one-sided TP method. So economically relevant characteristics are such that they can be reliably priced using one-sided TP method. So one-sided TP method. The second scoping criteria is a quantitative metric. It has a quantitative metric that makes use of operating expenses. Quantitative metric that makes use of operating expense criteria. In fact, this makes use of annual net operating expense as a ratio of annual net revenues. So there's a ratio, and that ratio has to be kept in mind. The qualifying criteria has to be within that ratio for the scoping criteria to kick in, right? And then there are exclusions. So commodity transactions are excluded. And then there is one more criteria. Fine. So I intend to make a separate video on qualifying transactions and scoping criteria, that is section number 3. So probably I'll discuss this in greater detail in that. But you must understand that buy sell marketing and distribution activities, as well as sales agency and commissioner transaction, they are in scope, and then they are qualifying transactions. And then further you have scoping criteria, that is the economically relevant characteristics should be such that one-sided TP method should be applicable upon them for the pricing part. And then you have quantitative criteria based upon annual operating expenses as a ratio of annual net revenues. Fine. commodities transactions, they are excluded. Section number 3. Section number 4. Pricing methodology, the most appropriate method. Most appropriate method. The most appropriate method, OECD chapter number 2 has got very detailed, OECD TP guidelines, chapter number 2 has got very detailed guidelines as to what are the criteria that should be kept in mind while choosing a most appropriate method, MAM, right? Most appropriate method. So it refers to that most appropriate methodology has to be preferred, most appropriate method has to be preferred, and then it goes on to further say that based on the scoping, qualifying transactions and scoping criteria, a one-sided TP method has to be preferred. And that which is the one-sided TP method? So we know that cost plus method, resale price method, and transactional net margin method. These three are the TP methods which are one-sided methods. So it finally it zeroes in upon that it selects the transactional net margin method, TNMM. So TNMM, transactional net margin method, is the method of choice. So TNMM has been chosen as the method, most appropriate method for pricing of in-country, in-scope, qualifying, baseline marketing and distribution transactions, right? TNMM. Now there is an exception. The exception is wherein the jurisdictions have, although it would be rare, this would be very rare, but wherein jurisdictions can get hold of comparable uncontrolled price method, where the jurisdictions can apply comparable uncontrolled price method reliably by making use of internal comparables. By using internal comparables, where the jurisdictions can reliably apply, where they feel they can reliably apply comparable uncontrolled price method, which is a two-sided method, by making use of internal comparables, then they need not apply. Then they need not use the pricing methodology that is referred to in this report, simplified and streamlined approach. In that case, they can use comparable and control price method using suitable internal comparables. Otherwise, the method of choice is transactional net margin method. Fine. Section 4, most appropriate method. Okay. 6, section number 5 is the pricing matrix, pricing methodology. Methodology. In fact, section number 5 is the heart of this report, is the heart of the entire amount B or simplified and streamlined approach. This is the heart of the section number 5. And as I've already told you that I intend to make a separate video on section 3 and section 5, that is scoping and qualifying transactions, and then pricing matrix. But let me give you a brief gist about this section here. So you have pricing matrix. Pricing matrix. Section number 5 has got 4 subsections. So first one is pricing matrix. Of course, you have pricing matrix. Then you have operating expenses cross check, the cap and collar mechanism. Operating expense cross check, that is the cap and collar mechanism. Operating expense cross check, cap and collar mechanism. Then you have data availability mechanisms for qualifying jurisdictions. And then finally you have periodic updates every 5 years. Fine. Pricing matrix. See, you know what? Relevant benchmarking criteria. OECD when it started working on the amount B, it chose relevant benchmarking criteria, and those relevant benchmarking criteria were used on the Moody's Bureau Van Dyke Orbis. This is the name of the database software. Moody's, Bureau van Dijk, Orbis software were used with relevant benchmarking criteria, and this led to a global data set of companies. Global data set. So global data set, a set of companies, global data set of companies was arrived at. Global data set of companies was arrived at from this Moody's, Bureau van Dijk, Orbis data set. Now, upon arriving this global data set of companies, those companies which are engaged in the baseline marketing and distribution activities, right? So these companies were engaged in baseline marketing and distribution activities, and these activities, and on the basis of this data set, their financial information was taken, their financial data was taken, and this financial data has been used. This financial data has been used to prepare this pricing matrix. This financial data has been used to prepare this pricing matrix, right? So benchmarking criteria, Moody's, Bureau van Dijk database, Orbis, you found out a global data set of companies, and their financial data has been used to create this pricing matrix. Now, pricing matrix makes use of factor intensity classification. So it makes use of operating asset intensity, it makes use of operating expenses intensity, it makes use of industry grouping. So there are 3 industry groupings. Fine. You understood this much? Let me check. Let me quickly run you through, because I'm going to make a separate video on this one, pricing matrix. So pricing matrix is actually a matrix, right? It's a matrix. So vertical column, 3 columns, column number 1, 2 and 3. Right? So 3 vertical columns, 1, 2 and 3. Industry grouping 1, industry grouping 2, industry grouping 3, and then you have 5 rows. 1, 2, 3, 4 and 5. So this contains factor intensity classification. So here you have OAS and OES. Fine. Here you have OES, factor intensity classification, high to low, and here you have industry groupings 1, 2, 3. And so you have you'll have number of cells. How many cells you'll have? 5, 3, 15. You'll have 15 cells, and these 15 cells, they contain entries, and those entries are basically ROS, return on sales. You must remember that TNMM has been chosen as the preferred method. So TNMM, transactional net margin method, makes use of what? Net profit indicators, NPIs or PLIs, profit level indicators. So here the relevant NPI or the relevant PLI that has been chosen as a metric for pricing of SNS approach is the return of sales. So you'll have you'll have 15 entries in these cells. So this is the pricing matrix. Rest of this when we have a separate video on section number 5.